Greetings. What is this chart right here that you're looking at? This is from Calculated Risk blog, and it is the price of framing lumber, which is used in the construction of houses. You may have heard a year or two ago that the price of this has shot through the roof, and that was used as an example of how everything is rising in price supposedly, and we are amidst hyperinflation. This one anecdotal piece of evidence for one type of product. And yes, the price did rise from $400 all the way to $1,600 because the low interest rates of the Federal Reserve and the purchases of mortgage-backed securities triggered a huge amount of house construction. But as quantitative easing ended and that purchasing of mortgage-backed securities ended and interest rates on mortgages rose, the price of framing lumber fell back down, and it's the same price as it was almost 20 years ago, $400. So this was a non-event. It was high for about a year. And that's why when it fell, people stopped talking about it, but they didn't stop to think about maybe inflation is not that high. So that was framing lumber. Now we'll go to something else. What is this chart over here? This is the price of a dozen eggs in the United States over the last 10 years. For 1 month, it was quite high. It was $4.32. 1 month. Then it fell down really fast, because even this was a situation of just a temporary shortage because of supply-demand mismatch and supply chain bottlenecks. It was very brief. It was only for 1 month, yet the amount of hysteria around this was extremely high, as you can see from my video up here in the upper right hand corner that was made at the time of this peak, where I predicted that the price of eggs was going to fall just as quickly as it rose, and that is in fact what happened. Look over 10 years, it is the same price as 10 years ago. It is not that much higher than it was even 43 years ago. It's maybe twice the price that it was 43 years ago, even though the conditions under which hens are kept have improved, and therefore you'd expect there to be a structural price rise in the price of eggs, but nonetheless, it only doubled in 43 years. That is much less than 2% a year. This was a non-event to end all non-events. Absolutely nothing happened. In this one particular month of January 2023, maybe some people ate a few fewer eggs than they otherwise intended to, but now they can catch up and make up for lost time because eggs have become inexpensive again. Make up for lost time, and then some if you want. Knock yourself out. So now we see that these anecdotes are often presented as proof of inflation, and that is very unscientific and innumerate. So let's look at actual inflation statistics, which is the primary purpose of this individual video. So as always, we have my three-legged stool, the US CPI 10-year compound annual growth rate. You need the 10-year compound annual growth rate to smooth out flutters of high as well as low inflation and get some idea of long-term trends. Then the most important measurement of all, the GSCI, Goldman Sachs Commodity Index, 10-year compound annual growth rate, it is by far the most important measurement because it is comprised of freely traded items and it is worldwide. The two things that people object to in using the CPI, which is that it's US only and that it is a government published index, are both nullified by the Goldman Sachs Commodity Index because the price of oil is freely traded, the price of gold is freely traded, natural gas, silver, everything. This is by far the most holistic, most important, and most comprehensive measurement of inflation. And then the 10-year US Treasury yield, which is more in anticipation of future inflation but has a tremendous effect on rents, mortgage payment prices, and housing prices. And I need all three of these to be above 3% before I say that structural inflation is high. If only one is above 3% and the other two are not, that does not mean inflation is high. And remember, this is optimal inflation. Being at 3.1 is not some disaster. That just means it is 0.1% above optimal. Then hiring is sluggish, as well as price earnings ratios on the S&P 500. Real estate price gains, home equity gains, net worth, everything is bad when inflation gets too low and we slip into deflation. I've explained many times why deflation is bad on this channel. You can search for multiple videos about that on this channel. And so let's look at each of these three to see what they are today, July 16th, 2023. 10-year US Treasury yield, 3.82%. This one is above 3%, but it has been for several months. And it cannot really break above 4%. It is suspended in this zone of the high threes, but still a 3 handle, which is a way of saying that it's still 3 point something. It is not 4 point something. So this one is above 3%, and this is exerting negative pressure on both the U.S. housing market as well as the amount of interest that the U.S. federal government pays on the national debt. And I've talked about that in other videos, but this is 3.82%. Now the Goldman Sachs Commodity Index, Goldman Sachs Commodity Index 10-year compound annual growth rate, as signified by pressing this button for 10 years, minus 1.35%. It is in deflation over the last 10 years, partly because of oil, partly because of gold. Oil is cheaper than 10 years ago. Gold is the same price as 10 years ago, contrary to what gold bugs will admit to. Deflation for the most comprehensive index. Again, it is comprised of freely traded items, so it is not riggable, and it accounts for the worldwide price. So if the dollar is strong, dollar is weak, all those factors are canceled out because this is comprised of things traded worldwide. It is a very comprehensive index, and it is in deflation. Now we go to the US CPI. This is from the bls.gov website, and every month I do this video, I have to make a decision about whether I want to explain this methodology in detail for first-timers or if long-time viewers are going to get bored. So I'm going to make a decision this time to not explain everything in too much detail, refer to prior month videos for that. But this is the CPI number over here. And the 10-year compound annual growth rate is calculated by taking this most recent number, 304, and dividing it by the number exactly 10 years ago, which is 233, and taking the 10th root of that. And I'll show you a table that tells you what all those things are. And this is the 1-year amount of movement. As you can see, there was a flurry that was higher, which is now long in the past, more than a year in the past. The same goes for the 2-month inflation moving average, the 3-month inflation moving average, the 6-month inflation moving average, and now even the 12-month inflation moving average. This rose up and people became hysterical because of framing lumber and eggs and a couple other things, and it fell just as fast and is still falling. And it was going to fall anyway without Federal Reserve tightening, but that is why this was really a non-event in the grand scheme of things. In the history of the US economy and the world economy, this was not a big deal at all. Now, to take all those graphs into our familiar table to make it easier to look at, so here you see this table, and the function of this table is to take all those varying time windows and annualize them as though they were all stretched to a 1-year window as their rate, which is to say, what if the inflation of the last 1 month, what is 12 times that compounded to get an annual rate? So for 1 month to the 12th power is what it has to be. For 2 months to the 6th power, for 3 months to the 4th power, 6 months to the 2nd power, a square, 1 year straight, 3.1% as we can see. And then 2 years is the reverse. Square root, cube root, 5th root, and 10th root. And as we can see, the annual CPI gain for everything up to even 1 year is at a very low zone, 3.1% over the last 1 year. I've had a lot of agitators come over when this number was temporarily high at 8%, and they said, only the 1-year window matters, 10-year window doesn't matter. But those people are nowhere to be found because they're very intellectually dishonest and they're desperate to be knowledgeable about an impressive sounding subject, but they're not up to the task, sad to say. 3.1% over the last 1 year, and all the recent months are low. That bulge that we saw in the CPI is now in the 2-year and 3-year windows, higher than normal certainly, but it's in the past because it's more than 12 months away. And the number that's important, I consistently stay on this, as all long-time viewers know, is the 10-year average inflation rate, which is 2.7%. 10 years is what matters because these short-term windows are always volatile. There's a lot of noise, even at the 1-year level. But for those who think 1 year is important, fine, it's now 3.1%. It's not going to rise anymore. It only rose because of the Russia-Ukraine war pushing oil prices high for a short while. That is more than 1 year ago, and oil prices have come back down somewhat and still have further to fall. But 2.7% is what matters. When this is above 3%, then I'll say yes, CPI inflation is slightly higher than optimal. So we go back to my matrix. So we saw all three: 10-year compound annual growth rate of the US CPI, 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and 10-year US Treasury yield. And the answers were 2.7% for the US CPI, so below 3%, minus 1.35% for the Goldman Sachs Commodity Index. This is pretty volatile. It could go back above 3% in theory in a very short time, but that does not seem to be happening unless you think gold is going to rise by a lot and oil is also going to rise by a lot. So this is in deflation, the most important of the three. And the 10-year US Treasury yield is 3.82%. This one is above 3% and exerting downward pressure on housing prices. Keep that in mind. But only one of these three is above 3%. I say money should be printed, quantitative easing, to the point that all of these three are at or near 3%. That is what the optimal policy should be. The nature of money printing should also change, as I explain elsewhere on this channel. But This is where inflation is right now. I've taken a very data-centric approach. No anecdotes, no emotional need to push a narrative or anything like that. And I've been very consistent because there's a lot of archives of this monthly video series. And no, inflation is not high. I don't care what anyone says, because everyone who says that it's high is not using a data-based argument. The type of arguments that they use, I rebut in this video in the upper right-hand corner, Kartik's law of inflation. So if you're not familiar with that, you may want to go look at that. But if you found this type of content to be informative and this data-driven approach to be enlightening and helpful in your quest to cut through the media narrative, because the business model of the media is pessimism, of course, then I encourage you to subscribe to this channel, and thank you very much for watching.